Festival of Lights is here. We at CNBC TV18 wish you, our viewers, a very happy Diwali. It's been a year of the unexpected in the stock market. A year in which the usual heroes kind of failed. The underdogs actually shined. The year when large cap stocks lagged and mid caps and small caps sparkled. A year where traditionally strong sectors like private sector banks, for instance, they underperformed and the once ignored PSUs sizzled like never before. It's been a roller coaster filled with plenty of learnings and yet more questions. Therefore, this is an apt time to get into the classroom with our market masters. Hello and welcome to the Diwali Masterclass. I'm your host, Surabhi Upadhyay. Today, we have with us a very vibrant audience in our studios, and they're brimming with lots of questions, as I can see. They're looking to ask questions on their investing habits, on the funds they should buy. And to answer all these queries, we have with us three market veterans who will teach us the key lessons to keep in mind and, of course, take in all of these heavy-duty questions that are going to come their way. So let me welcome my guests on the show. We are joined by Nilesh Shah, MD, Kotak Mahindra AMC, S. Naren, ED and CIO at ICICI Prudential AMC, and Mihir Vora, Chief Investment Officer at Trust Mutual Fund. Gentlemen, such a pleasure to welcome you in the studios. Season's greetings to all of you. And season's greetings to our audience as well. It's a nice, vibrant bunch we have here, and really appreciate all of you coming in and joining us here in our studios. So, before we get started, this is how this classroom is going to work. Let me quickly tell you, folks. We have our three teachers who have prepared three separate lessons for us, and each of them are going to talk about that subject in a bit. And then we will allow you, of course, to ask all of your questions as we go along. So promises to be interactive and very interesting. But before we get started, I must do a throwback, right? Because it's been such an interesting year. And as I said, I mean, we've learned a lot, and yet we are, confused even more. So Nilesh, throwback to the Samvat that's closing out. What thoughts?
So this Samvat had a lot of unexpected turn, but at the same time it rewarded patient investing. Yes, there has been a crazy run in micro caps, small caps, mini caps, but fair enough, that's the nature of the market. If you are an investor, despite all the things which have happened in the world, there is reward in our market.
Okay, so be patient, stay the course, and the markets will reward you. That's been perhaps Nilesh's takeaway. Naren, what about you, and what stood out for you as you look back at the last 12 months?
I think what stood out was the fact that India macro has been managed so well in 2020 that inflation and current account deficit and all those macro issues which the Western world had, India did not have. And this is despite, Ukraine having problems and so many other problems which came up in 2022. India had one of the most calm macro environments, which resulted in equity investors staying with the industry and continuing to do systematic investment plans in mutual fund industry and in direct equity also investing. This resulted in the most unsafe markets of equity actually doing very well, and the most safe markets in equity doing badly relative to that.
Imagine that large caps were almost a no-go zone, right? And it was all about high-flying mid caps and small caps, and we have lots of questions from the audience exactly on this. But Mihir, your thoughts on the last 12 odd months?
One is, as Naren mentioned, the resilience of the Indian economy and the way the government has really managed the oil price issue, etc., in spite of lots of geopolitical issues out there. So amazing resilience and good job done by the RBI and the government. I think what stood out was the resilience of the Indian entrepreneur. When you're talking about mid caps, small caps, micro caps, is basically thousands of entrepreneurs' success stories now coming to fruition. We can debate valuations, that's a separate issue, but the fact is there are so many interesting segments, companies which have been nurtured and now growing to a certain size. It shows the vibrancy of the Indian economy. And the third is the fact that a lot of these sectors are actually being supported indirectly or directly by government initiatives, whether it's on capital spending or enabling through PLI, etc., creating a better environment. So I think we are on the right path, macro-wise as well as policy-wise.
Okay, before I get started with our classroom, as you said, if one is a long-term investor, a long-term India bull, then there's no problem. You just keep investing and keep riding the wave high. But for the near term, if I ask you about the next 12 months, the new Samvat that's going to start, Nilesh, what is your feeling? I mean, are you a little concerned or are you still very bullish? What's the frame of mind with which you're getting into Samvat 2080?
So whenever you have to take a short-term view, obviously there are challenges. Last year, none of us would have predicted that small and mid caps will deliver this kind of return. In fact, I remember many stalwarts who were bearish on equity at that point of time. So one, we have to accept our limitations that we don't have ability to predict short-term. Undoubtedly, market knows the challenges. US interest rates likely to remain higher for longer. Energy prices could get disrupted thanks to what's happening in Middle East. In India, consumption growth will depend upon this festival season as it has remained subdued at the bottom of the pyramid. And more importantly, our valuations are pricing in a perfect scenario. And on top of it, there is an election in the middle of the year. So there are enough challenges, but market already knows this, and despite that, it is trading where it is trading. I think as long as India delivers on 3G, the first G of growth, this quarterly results, we are showing earnings growth of about 26% for the results which have been declared. Some of our peers haven't shown 26% earnings growth in 5 years. We have to deliver earnings growth which is better than the peers. The second thing is governance. Today, our governance standards are comparable with the best in the world. Many of our peer groups are lagging far behind. Now, obviously, they can catch up. Governance standards will keep on improving. So we have to ensure that we remain in the lead. We respect investors' capital which is coming in. The third G, the 3G and the final G is green. We are the lowest per capita carbon emitter in the world. Today, we have 21% of our energy coming from renewable sources. Today, we are one of the few emerging markets which is on its way to achieve COP26 targets. I don't think so. World has given us enough credit on this green transformation. And we must ensure that this is well known to investors. This combination of 3G, growth, governance, and green, as long as we deliver, we'll be able to overcome all the challenges. In a very simple one-line message, every correction is a great opportunity to invest into India.
Okay, so that's the eternal bull, I guess, the bullish view that is there for the long term. So with that, let me quickly kickstart the classroom as well. And Nilesh, why don't you just quickly take it away? You are going to talk about how to dispel darkness when it comes to investing. Okay, tell us more.
So Diwali is the, festival of lights which dispel darkness. In India also there is darkness on financial awareness. In mutual funds, a lot of investors have made money over 15, 20, 30 years. But total number of investors which we have is 4 crore. On the other hand, in cryptos, most of the investors would have lost money. And 18 crore investors went and dabbled over there. Now, why are people going into where there is guarantee to lose money and not coming in sufficiently where there is opportunity to make money? Is it intelligence? Answer is no. India's most literate state spends more money on lottery than what they have accumulated in equity mutual funds over the last 3 decades. In lottery, you are bound to lose money collectively. Otherwise, lottery guy will never run the business. And yet, annual spending on lottery is more than the cumulative AUM in equity.
So there's a long way to go.
We have to create financial awareness so that people invest nicely, wisely, and they get financial security. 18 crore Indians have lost money in cryptos. 10 crore Indians would have lost money in gaming. 2 crore plus Indians have lost money in Ponzi schemes from PSEL to City Limousine. And there are so many people who lose their future in F&O trading, from cash, equity to commodities to everything.
If you could just hold that thought, I quickly want to get to the audience to get a dipstick check, Anybody in the audience who experimented with crypto or invests, nothing wrong with it, just trying to understand, who are the high risk takers here? I think we have 1 hand going up, all right, 2 hands going up. Anybody who's an active F&O trader? Just to get an idea of the risk appetite of this audience. Okay, about 2 to 3 people here. So in general, I think people want to experiment with asset classes or, securities that could offer better returns if you take high risk.
आप आपकी health के लिए experiment करते हैं by eating one cola, drinking one cola or eating one junk food, it is fine. But if that becomes your main food, then there is worry. So as long as you are experimenting, please, go ahead and do it. But for ordinary investors, they have to remember that trading is injurious to your financial health.
Okay, fair enough. I think that's saying it as you see it, and you see so many investors out there. We do have to take a very quick break. Now, that is just the first lecture. We are, waiting to hear from our other 2 market masters as well. So we take the break and the conversation continues on the other side. Welcome back. Here with the CNBC-TV18 Diwali Masterclass, and it's time for the audience to take the center stage and really ask their questions. I think we have plenty coming in. I'll start with Nilesh Shah. Nilesh, can we see you? Okay, there you are. Welcome to the show. Go ahead, ask your question.
First of all, I'm very glad to be here. I wanted to ask, passive as a strategy is very big worldwide, right? And in India, it's still gaining momentum. People are still trying to adjust to index funds and kind of just learning about them. I wanted to ask, what would be a good strategy? Would it be passives, only actives, or a mix of passive and active both in your portfolio?
Okay, I'll ask the panel. Interesting question for sure. And I think we got these queries during the course of the year as well, because a lot of fund houses have started now launching mutual funds which mirror the index itself, the mid-cap index or the small-cap index. So basically passives on even mid and small caps. Naren, what's your take on this trend and what would your advice be?
If you look today at anything other than mid-cap, you'll find that actually huge alpha has been created over the last 1 year, 3 years, even 5 years at this point of time. In mid-cap, it's quite a different experience. Mid-cap funds have done very badly against benchmarks. So passive has done very well. So you go through these phases. If you had looked at 2018 end or 2019, passive had beaten active very, very much in most of the large cap funds. So you go through these cycles, but at the same time, on a continuing basis, I think we have a tortoise in the form of passive, and we have to recognize that. And having said that, there will be times,
the race in the
but
end.
You should see today the performance of actives against passives in large cap. You will find that most of the, no one talks about it today, but most of the large cap funds and most of the flexi cap funds have done so well against the index over the last 1 year, 3 or 5 years by a huge margin. When they underperformed, people kept talking about it, but today when they have outperformed, no one is talking about it. That is one of the regrets of an active manager like me.
Not at all. That's why we have you here, because we want to hear from you. And, when you put out some of these snippets, I'm sure people will keep it in mind and go back and
But truly in mid-cap, it's still, at this point of time in mid-cap, passives have beaten active hollow. But in all other categories, actually on the last 3 years and 5 years, actives have actually done pretty well.
Okay, I love this active-passive debate. It's an evergreen one, and at least in India, it is going to continue to be a vibrant one for many years ahead, right? Okay, so coming back to the classroom, Naren, let's get to your lecture. You are going to teach us a bit more about asset allocation today, right?
Yes.
Okay, so tell us, how should we look at asset allocation? Why is it important? And how should we go about, asset allocation as we get into this new year?
See, 2007, 8, 9 was a red letter period, where, as Nilesh pointed out, the number of investors in India in mutual fund is still very small. So we felt that, this mutual fund industry saw itself as an equity mutual fund industry. And we said that we have to move out of that and move into a situation where we created categories like balanced advantage and multi-asset. Because if the mutual fund industry was not a equity mutual fund industry, actually gold gave very big returns in 2008. And consequently, this whole thing, we started popularizing categories like balanced advantage, and later when scheme categorization came, categories like multi-asset. Because once we did that, we got the real benefit actually in COVID, because in COVID actually equity did badly immediately, but asset classes like gold did well. And we have had a situation where this whole concept of asset allocation, where you invest in equity, debt and gold, actually leads you to a very good experience compared to just investing in equity. And the problem that Nilesh pointed out, that investors are much more invested in other things and not in mutual fund, can be corrected only in that way. Because the day you make it an equity mutual fund industry, you cannot make the industry as large. Look at the scale of all the other industries, they've been much bigger. So that's what we felt, and the experience of 2018 to 22, as the data would show, there are years in which equity has done well, there are years in which gold has done well, and then the investor experience is much better, and then you can scale up the industry. And today, all of us in the industry have launched multi-asset funds, primarily because we have realized that that is one way of increasing the number of investors in the industry and ensuring that the investor experience can also be much better over the next 3 years, 5 years, 10 years.
Okay, absolutely. And I guess as that data was showing, it's very volatile, these three asset classes. When one does well, the other is usually languishing. So maybe a mixed approach works. And it's also tax friendly, right? I mean, the multi-asset funds have the tax advantage.
That is less important than the fact that, you know, in a year like 2020 or a year like 2008, it is gold which gives you the return. And in other years, it is equity which gives you the return. So it kinds of, because finally at the end of the day, the return that you get in other asset classes is low. But this balancing influence actually moderates the investor experience, but gives an investor a much better experience.
Okay, great. We have some more questions from the audience coming in. I think Yash Parekh, Yash, there you are. Welcome to the show. What's your question?
Thank you so much. First of all, great to be here. Thank you, Surbhi, for having us here. I have one question on style investing, that is growth versus value. So, I personally believe it is very cyclical in nature. For an example, between calendar year 17 to 19, growth outperformed value by around 20-25%. Between 20 to 22, value outperformed growth by around 10-15%. So, first of all, how to determine what are the parameters of when which style to adopt, and what are the parameters which helps you to decide when the cycles are changing. That will help us to, to make a better influence decision.
You know, I'm going to give this question to Mihir because his classroom lecture today actually is, relating to this subject. Mihir, you're going to tell us about this beast called valuation, how to look at it, how to befriend it. At times we want to forget about it when the market is running away. So I think it's a question that a lot of us grapple with. And as our friend here is asking, this has been the year of power stocks and capital goods stocks. I mean, these stocks never worked for decades. Absolutely. And now here we are.
Absolutely. So it's a very pertinent question at all points in time in the market, not only today. So I mean, philosophically, when you're talking about investing in stocks especially, it's a function of various parameters, and stocks and companies are impacted by so many variables. So as an investor, the only thing that is in our control is the price at which you enter or exit the stock. And that's where valuation comes into the picture, right? Because if you think the actual value of the stock should be much higher than what the current market price is, then you buy, and vice versa. If you think the actual value is should be below the current market price, you are a seller in the stock. So valuation, when you go about valuing a company, basically at the crux of it, you're trying to say this is the current book value of the company, and the company is likely to generate cash flows in the future. So let me calculate the value of those future cash flows. Typically, near-term cash flows are more predictable, more visible, and the far out cash flows are less predictable, less visible. So what we call the first 10 years, typically 5 to 10 years, is the visible or the forecast period, and beyond that is what we give a terminal value. Now, the terminal value also assumes a certain growth rate beyond the 10 years. What happens is that in high growth companies, if you look at the overall value of the when you calculate the overall valuation of the company, the value of the terminal value is dominant, and the value of the near-term cash flows is less dominant, and vice versa. In slower growth companies, typically the value of the near-term cash flows is higher. So what growth investors tend to do is they don't mind taking a far-out view. They would ascribe some significant value because they do expect the growth to continue for a longer period of time. So when you look at the value investor, they tend to give more importance to the visible, the tangible net worth, the tangible book value and the near-term cash flows. That's where the difference in philosophy happens. In bull markets, people tend to be more optimistic. They want to see far out in the future, so maybe the growth investing style works better. In choppy markets, typically people are risk averse. They say, no, let me focus on the near term. I don't know what's going to happen in the future. So that's when typically the value style comes in the focus. So it's to some extent a function of the sentiment and the business cycle that we are in. So that's where the difference between growth and value comes in.
And personally, would you call yourself a growth stock picker or a value stock picker?
I'm personally a growth stock picker.
Okay.
Because we are in India, we are a growth market. And one of the things that you keep reading is that Indian market valuations are at a premium to global, so we are expensive. But the fact is that I looked at the data since 2006. India has traded at a premium to all other markets, including emerging markets and developed markets. And that's because India has always given higher growth in terms of GDP, in terms of corporate earnings. So valuation takes into account long-term growth, and India has delivered long-term growth which is superior to others, and so we've always traded at a premium. So that's where the heart of a country, when it's growth. I'm a growth investor for India.
Okay, got that. We have another question which kind of ties into this theme. Naveen, I know you have a question on PSU stocks, right?
That's right, ma'am.
Yes, we can hear you.
So firstly, thank you for the opportunity for getting me here, and I can interact with the gurus of the stock market. So my question is that lately we've seen that PSU stocks are back in favor, and these represent both growth and value in one. So because of this, should retail investors now pay attention and have a portion of this of their equity portfolio? What percentage of such stocks should they keep? And is it that they play this through these ETF, CPSE ETF or the Bharat 22 ETF route rather than buying stocks directly? So could you throw some light on it, please?
Great question. I think it's a question that will resonate with a lot of our viewers, I mean, the audience here and the viewers on the channel. Naren, you want to take this one? First of all, PSU stocks, I want to ask Nilesh as well. Are they growth stocks or are they value stocks at the end of this year now?
I think it's tough to say. 3 years back, on every meeting we used to be asked, how can you own PSU stocks? It used to be such a difficult task to convince people that those PSU stocks were worthwhile. 3 years later, now the questions have changed substantially. So at the end of the day, they were deep value stocks 3 years back. And when they were deep value stocks, it was so easy for us to buy them. And today, when they are no longer deep value and today they are actually growth stocks, some of them have become from deep value to some of them are deep growth stocks. So frankly, it becomes a debate that there's no straightforward answer for anyone to be given. That because finally at the end of the day, you have to look whether that deep growth is implied is too high or is it not. But 3 years back, the debates same time was so different, and now it is so different.
Which is why I said, right, this has been an unexpected year, the year of the unexpected. Very quickly, 30 seconds before the break, but your take on PSUs. Are they growth? Are they value? Should they be bought, not bought? What's the advice?
They cover entire spectrum from value to growth at reasonable price to deep growth. There is oil marketing companies which are still valued today.
Exactly.
There are companies in banking and many other manufacturing PSUs which are at GARP. And there are some low floating stock PSUs which are there today only because floating stock is limited. The day divestment begin, prices will fall significantly from here.
So tread with caution. I think that explains it really well. Thanks to both of you. We'll take a very quick break. We come back on the other side and then we get to the heart of the conversation. Lots of questions on the mid-cap frenzy in the market, and I know our audience is looking to ask more. So back in just a moment. Welcome back here with the CNBC-TV18 Diwali Masterclass, and now the floor is open for questions, and we have a very vibrant, audience, a mix of all age groups and a couple of students as well. So I promise all three of you gentlemen that this is going to be an interesting one. Let's start with Mit Ambani's question. Mit, hi, welcome to the show.
Thank you so much. So basically my question is, despite the perception that, currently mid-caps are somewhat overvalued, considering that, is there any specific sector in the mid-cap space that can be a potential in the near term? So what do you think on it? What is your take on that?
Okay. There are a couple of questions on mid-cap. So allow me to, bring all the questions together and then I'll toss it to our panel of experts. So you are looking for mid-caps which can still offer some good return. Basically, that's your question. Got it. Shivam, I think, also has a question. Shivam, you have a question on mid-caps?
Yeah, thank you for the opportunity. My question on midcap is bit related to MFs. Now, as we see, midcap is not a very broad-based universe, 150 stocks, as compared to say small cap where we have 5,000 odd stocks. Now, midcaps is not also as liquid as large caps, which starts from say 47,000 crore and goes up to 17 lakh crore. So in scenarios like this, are we seeing a bit stretched valuation wherein reports are coming out on mid-cap saying that it is bit overstretched, and is too much money chasing too few stocks in the mid-cap? So that's my question on mid-cap.
Okay, so I think the order is basically your question first, whether mid-caps are overvalued, and then even within an overvalued space, what can you still buy? I think we'll go in that order. So Nilesh, you want to take this first to begin with?
Sure. So beauty is in the eye of beholder. Valuation is in the eye of investor. If you are investing with 1 year horizon, maybe you will find something expensive. If you are investing with 5 year horizon, maybe you will find it not expensive. Second, within the sector, it is always the promoter which makes the difference. You need to make money through good company in a good sector, run by a good manager. Otherwise, manager सारा पैसा घर पे लेके जाएगा, minority shareholders का कुछ होगा नहीं. Within those caveats, right now, mid-cap does look little bit higher from historical average valuation, but every rule has an exception. Number two, yes, mid-caps are illiquid compared to large caps. But as of today, all the mid-cap portfolios across large, mid and small cap funds is about 22 to 23% of float available. And we are talking about float, not the market cap. The collective mutual fund holding of entire market cap put together is about 8 to 9%. There's still 92% which is not with us. So yes, it is a challenge, but that's why we have to manage it. And we think we are at a stage where we can still reasonably manage. Of course, you would like to buy mid-caps at March 20 valuation, but then there should be FPIs who are willing to sell at those prices. Now, they have also become smarter and they are not selling desperately. So you have to pay a fair price in today's market to buy the portfolio. But most of us are spreading our investments to ensure that there is enough liquidity so that we can pay our redemptions, which are on a daily basis. We are by and large investing in companies with real businesses run by good managers, and regulators have empowered us to ensure that governance standards continue to remain better. So hopefully we will be still able to create value in mid-caps. And as Naren mentioned, on a 1 year basis, 3 year basis, we have underperformed benchmark indices because there are certain stocks which have run up with limited float and so on and so forth. Hopefully those things will get corrected over a period of time.
Okay, so that's the the take on valuation. Mihir, you want to comment on this in terms of, like, to his question, the mid-cap pockets where there is still some value, where there's still potential upside. What do you see, if at all?
Sure. The thing is that we talked about Indian economy growing, and the segments in which there is growth which is superior to the rest of the economy, the higher growth segments, like it or not, they happen to be in the mid and small cap space. Large caps will not give you exposure to, say, a very large exposure to, say, to the defense sector or the railway capex theme that we are talking about, electronics manufacturing we are talking about. We are talking about the fact that government is still going to spend a lot on road building, on government buildings, infrastructure, etc., capital goods. The private sector investment theme is just picking up, real estate. So most of these segments, if you, are the highest growth segments in the next for the next 2, 3, 4, 5 years. And if you want to get exposure to these segments, you don't have a choice in the large
You
cap
have to be in
segment.
mid-caps.
Yeah, exactly.
And then you have to pay top dollar.
Exactly.
To get it.
And we said that, right? If we expect these segments to deliver higher growth than the rest of the economy for the next 3 to 5 years, then they will continue to trade at some premium. The question is it too much premium or some premium? You know.
That's the fine answer wherein, you know, fortunes really lie. In terms of mid-caps, I think there's one more question. Devendra, you had a question, I believe, if you can pass the mic. You had a question on mid-caps as well?
Yes. Thank you, CNBC and Surbhi ma'am. It's a pleasure to be.
Glad you could join us.
Sir, season's greeting to all of y'all. Would just like to know that by default, retail investors majorly are in mid-caps. And then even if you track the results, what is the best way to be a long-term investor and track the company's record onto quarterly basis results and everything? So we don't end up in a carnage, because mid-cap can take just 5 days and you are half the value of it from your entry price. So I would like to know, to throw some light on it, ma'am.
Yeah, that's a great question, I think, and thank you for asking that. I mean, while you're investing, taking on more risk, paying top dollar, high premium, getting into mid-caps, how do you avoid getting burnt? Who wants to take that? Naren, you want to go first?
I think basically that's why you come into a mutual fund, so that you avoid this. And the risk is also higher in mid cap and small cap and much lower in large cap, which is the reason why we believe in flexi cap over these things. But the reality, having been in the markets for long, the single first rule what we have seen is, if you invest in dividend paying companies which have been steady, then you avoid some of the mistakes. Like I was an infrastructure fund manager in 2007. If you invested only in steady dividend paying companies, you avoided many of the companies which went bankrupt. So if you avoided many of the leveraged companies, you avoided the worst companies. So the simple rule is stay with lower leverage companies, stay with companies which pay dividends consistently. That will avoid you to miss some of the big disasters. So if you see the worst disasters of 99 to 2001 and 2007-8, you had to avoid these two. That means you stay with dividend paying and stay with low leverage companies. But the best way is come into a flexi cap fund and come into a mutual fund.
Well, thank you so much. He's let us in on a little bit of that secret, right? High dividend paying and low leverage. So thank you very much for that. We do have to take a quick break on that note, but the questions will continue and our market masters will keep answering them. Back in just a moment. Welcome back. You're with us on the CNBC-TV18 Diwali Masterclass. It has been a fabulous session. We've had 3 amazing lectures from our 3 market masters here, and our audience has kept all the market masters on their toes with lots of very, very interesting queries. We have time for a couple more, so I'll quickly, get to Navita. I think you have a question?
Hi. I wanted to ask, thank you, first of all, thank you CNBC and
Glad
Surbhi
you
for
could be
having
here.
us here. And my question is, the US bond yield is expected to remain elevated for some time. The FII outflow, we are going to see some money going out from the FII side. And there's some volatility that is expected to stay in the market. So which are the categories which investors should be looking at in mutual funds?
Okay. Gentlemen, any one of you would like to take that?
So one, US interest rates are remaining higher for longer, but that's also because debt to GDP of US has increased so much. To give you a very small example, US is about 7 times our GDP, but their credit card debt is 40 times our credit card debt. And the student loans are 90 times higher than our student loans. So some part of this higher yield is function of increased supply and deteriorating credit standards. From our point of view, our competition is not necessarily with US Treasury, It could be with the other emerging markets. Russia is a no-go. South Africa is very risky. China has designed on Taiwan. They could become no-go soon. Brazil is a communist government. So for us, there is enough space to be an investor's portfolio as long as we deliver 3G of growth, governance, and green.
Okay, fabulous. So we don't have to worry too much and lose too much sleep over this 5% on the US 10-year. Got that. Great. Thank you. Aditya, I think Aditya has a question on mutual funds. Go ahead.
Yeah. Hi, thank you for having me. So my question is, we have seen a good number of new AMCs that have been come up into the market recently that have been launched. How do you see this as a potential to tap an untapped market of first-time investors?
Oh, okay. That's a bit of a business question. Who wants to take that?
Should I take it?
Please, Nilesh.
So more the merrier. When Unit Trust of India started mutual fund, they expanded the market. When SBI and other PSU banks came into mutual fund, they expanded the market. We all started our career when foreign mutual funds came and joined hands with local partners. We expanded the market. So more the merrier. Jitne zyada aayenge, we'll expand the market further. And as I mentioned, we have reached only 4 crore investors. I have to probably reach 40 crore more investors. How do I provide financial security to every Indian? Ek akela ye nahi kar paega. We need more people to do that task.
Okay, so the more the merrier, and there's so much happening. We discussed passives earlier on the show as well. So we have, I think, a question from Disha. Disha, are you there? Disha, yeah. Let's take your question.
Hi, thank you for having me. So my question is, with so many FIIs moving out, and then too the market is not much impacted because of the strong DII holdings. So will the DIIs be able to hold the market very well, or will there be any impact because of FIIs?
Well, these are the men and their managers who've held the market up this year, and they've done a fabulous job, haven't they? So what's the sense? Getting stronger and more powerful?
Actually, I believe that this is not a factor we should bother. We should buy stocks cheaper. And whether, like, if you look at periods of time where FIS sold very aggressively, like 2008, those were all, or even 11 or 13, those were all very good opportunities to buy. What matters is whether investors have bought at the right time in a very big way. And when markets are cheaper, if they buy aggressively, it's good. If they buy aggressively in periods like 2007 when valuations are high, it's a problem. This FII, DII debate is not a relevant debate. Relevant debate. What matters is when markets are down like 2020, whether investors, domestic investors put more money to work, and when markets are very high, whether they put lesser money to work.
Let me ask you where you gentlemen will put your own money to work. It's like a one-line question to all of you. Where are you investing this year? Mihir?
I would obviously go for equities.
And what type of fund? Give us something more specific.
Look, so as I said, I am growth biased. Okay. So flexi cap is the best strategy for me.
Okay.
Because then I can pick and choose, which segments.
So you're going the flexi.
See, India has ample scope for stock picking.
Okay, so going for growth. Naren, where would you put your money?
All types of hybrid funds.
Hybrid funds this year, huh? And Nilesh, what about you?
मैम 100 रुपया मिलता है, 39 रुपये सरकार लेके जाती है, 10 रुपया EPFO लेके जाता है, 10 रुपया NPS लेके जाता है, 20 रुपया I have to put into skin in the game circular from overnight fund all the way to the large, the sectoral fund. बाकी जो पैसा रहा बीवी को दे देता हूँ. So I have no money.
I think he just gave us the recipe to, how to be happy in life. It's all distributed evenly. No need to stress about it. Fabulous, fabulous. Time for one last closing question. Pranav, let's take your query because this is a question on learning. How can we learn and how can we evolve our investing style? Pranav, go for it.
Hi. Thank you. So my question is, as a young investor who is just getting started, how credible will be for him to put his trust on these financial influencers? So finfluencers era is going on. So how credible it will be? And if not, then what medium would you suggest for investment?
Oh, finfluencers. That's a tricky word these days. You should keep watching all the SEBI bulletins carefully to see what the latest is on that one. But gentlemen, I mean, the question is valid. If not finfluencers, then what? I mean, how can young investors, new investors keep themselves updated? What's the best way to keep learning? Mihir?
See, the point is, first of all, there's a term in legal parlance which is caveat emptor. Buyer beware. So whatever source of information or whatever source of influence that you have while taking a decision, ultimately the decision is yours. And there is no substitute for, common sense and hard work as far as making investment decisions is concerned. There is no easy way out, or leave it to the mutual funds.
No, absolutely. But even there, Naren, you want to sort of expand on this, even when it comes to buying the right funds, because we are in a country where people are still not really willing to pay for advice. Let's face it. I mean, that's the reality as us as investors. It's just the harsh truth. So in such an environment, how should you ensure that whether you're buying funds or stocks or any other, asset class, how do you protect yourself?
I don't know whether finfluencers are the right source of information. The way we've learned is by reading books and reading on, like I've learned from gurus like Howard Marks, who writes free on the web. So that's how a lot of people have on a continuous basis kept writing books also, which are 300, 400 rupee books also are there, which have been very useful. And use those books to use them to understand Indian markets. I found that more useful in my career rather than these because we don't know what is behind many of these things. Sure. And that's how we have avoided many mistakes. Sure. And you have to continuously keep learning. There is no choice, and the markets are not what it was. Today you have much more information. In 90s, when we first started investing, we had much lower sources of information. Today you have an overdose of information, but that overdose of information, some of it could be wrong information.
And you have to be very careful.
About
very, very careful. Any parting shots?
Just on information, I remember when we started our careers, an analyst used to be a guy who could compile polypropylene prices or polyethylene prices on an Excel sheet and take a printout and send it to us. That was an analyst. That was the level of information available.
Yeah.
And today, anybody with a mobile phone has probably 100 times more information than what we had in the 90s.
Yeah. It's the democratization of information that's happened, but we need to be careful. Any final thoughts, Nilesh?
Trust, but verify.
Wonderful. I think that really sums it up. Gentlemen, it's been a pleasure having you in our studios. And thank you so much for taking out the time, answering all these questions. And audience, you have been fantastic as well. So very interactive, very engaging. I thoroughly enjoyed it. And I'm sure our viewers at home also had a great time watching. It's a wrap on this edition of the CNBC-TV18 Diwali Masterclass. Once again, we wish you all season's greetings and a very, very happy Diwali.